Well, welcome everybody. Thank you so much for joining us on this sunny spring day here in DC. I'm Sam Vadas, and as we really try to make sense of some pretty unusual and particularly peculiar times in the markets right now, we've got a bit of an unusual program to bring to you today. I do want to introduce the gentleman sitting beside me and also on the screen we have today. But before I get to that, we have brought together some really great minds, top investment analysts from across the country and as far away as Belgium. So thank you so much. And what we've done right now is we're converging a bit of a new concept, and we have a collaboration which we're calling Curia Now. And what we are hoping to achieve with this is to try to discuss the approach that they are taking right now towards the market and discuss some of the top stocks that they are looking at right now and also of our keen interest and how they're approaching the market. So let's not waste any time in getting to our guests here today. I'm so glad to be joined beside me by James Early, who is the former Director of Research and Analysis at The Motley Fool, also the CEO of Stansbury China, and also the Chief Investment Officer at Bibei, which translates into
a bit like Get Wealth in Chinese.
Okay, great.
Brokerage
Fantastic.
company.
Okay, and also beside him, we've got Pieter Slegers from Belgium. So you've come quite far today, who has also come up with the handle Compounding Quality, which has become a bit of a household name online and has got quite an impressive following, I must say, as well, for the likes of Jeff Bezos and also LeBron James. And also on our screen today, we are joined by, dialing in from Houston, Texas, Simon Erickson from the 7 Investing website and podcast. So welcome to you as well, remotely. Thank you so much. James, quite an impressive gathering of great minds we've got today. How did this all come about? Why are we here today?
Well, first off, thanks so much, Sam, for doing this. And thanks to you guys for watching us at home. I feel like the uncertainty of the uncertainty is at an all-time high, at least in my 25-year investing career, it feels like. And I'm in touch with a lot of people. I have the privilege of knowing a lot of great investors. I got 2 of them with me now. One's on the screen, as you mentioned, and one next to me. We were speaking in text and WhatsApp. And in Europe, they love WhatsApp. And just discussing what to do in this market, because that's really the question every investor is facing. What do I do now? Whether it's my dad, my friends, like everybody's asking the same question. And we thought, hey, we're talking about this amongst ourselves. Why don't we get together and make a video about this? So that's how this came about.
Yeah, it's really interesting because, as a former journalist and I suppose somebody who has been talking to investors for a living, for a career, one of the things that we always say is, wouldn't you just love to be a fly on the wall of one of these sort of WhatsApp groups when, something big happens, and to really understand how investors are talking to each other. And I think that's really important to try to illuminate right now.
Absolutely. And that's our goal here today. We've got a couple of stock ideas to give, not recommendations proper, but just stuff that's on our radar, and talk about that, talk about some of the macro themes. I know Peter is more of a value guy. I know Simon from Houston there is more of a tech guy. And I've known Simon for many years. I've known Peter for a little while now. So hopefully we can cover a couple of bases, and there'll be something in this for every type of investor.
Excellent. Okay, so we're well acquainted. Should we, take a little bit of a sort of round robin approach to, sort of how we're looking at the market right now and some of the themes that are really key to investing at the moment as we try to cut through the noise? It's a very headline-driven market right now, and it's very important to sort of keep cool heads and let that prevail.
Yeah, I'm going to give the mic to my friend Peter in a minute, but just on your point, headline-driven market, it is an extreme headline-driven market. It is a policy-driven market. No time ever in my investment career has Twitter been a more important source of investment data than Bloomberg has, than Capital IQ has, than SEC filings have. But Twitter is what's moving the market. That's scary, and that might not be the case forever, but it's the reality right now. So if you're an investor, you're going to have to prepare. That's my take. Consistent tennis always wins in the market. Consistent tennis wins. I don't think you want to chase policies. I don't think you want to predict the unpredictable. We've got a handful of people making decisions that are affecting the US and really the world. And even this quasi-recession we're having, Sam, in the US is quirky. We've got rising bond yields. We've got rising inflation. It's getting harder for US consumers. That's the opposite of a normal recession. So a ton of uncertainty. I don't think the move is to try to predict policy. I think the move is to play a consistent game and let the market make mistakes and pounce.
You know, it's funny that you say that. Just very quickly before you pass the mic on to Pieter, is that, you know, something I've been reading a lot about is how investors really, the market is being driven by a single story, and it's called what some have coined as sort of the magazine effect right now, and really trying to hang on to some of those narratives, whether they're wrong or right. You know, what are the known risks? What are the unknown risks? And, you know, it depends on what you read on the front page of the papers. It's really driving the psychological approach to how people are looking at the market right now.
Totally. And one more thing before I pass it on, Pieter is going to say something better than what I'm going to say, I'm sure. But I'm personally worried about what I'm going to call a deadly 555 scenario. And that sounds really cheesy, but what I mean is if we have 5% inflation, 5% unemployment, and 5% 10-year yields, that's just a little bit higher than we got now in each category, and any one of those variables is not too bad. You put them all together, you've got a recipe for stagflation. Stagnant economy, high inflation, just like we had in the 1970s. It was a volatile yet range-bound market. What I mean, it zigged and zagged quite a bit, but the end result was the same. If we have that deadly 555 scenario, watch out, and you're going to want to be in safer stocks than you think.
Thank you very much, James. Couldn't agree more. Well, I think it was Peter Lynch who said, well, if you spend 30 minutes a year on macroeconomics, you've wasted 10.
30 minutes too much.
Yeah, exactly. So I basically think, well, nobody knows what will happen with import tariffs, with Trump and so on. And life as an optimistic investor is beautiful in that sense, meaning when the markets go up, that's great, your investments go up, you grow your wealth and so on. And when the markets go down, also great because we are still working, you can invest a certain percentage of your salary or of your income in stocks. And the best thing that can happen to you, and it doesn't feel like that, is declining stock markets if you are a net buyer of stocks over the next 10 years. So these kind of times actually make me very happy. I love the uncertainty in the market. I love the volatility because it provides tremendous opportunities in general. So yeah, really excited for this.
There are 140 million investors in the U.S. and one is happy right now in this volatility. And I know you're in Belgium, but you're in the U.S. right now.
Yeah, I'd like to bring Simon into the conversation and then get some of your thoughts.
Sam, there are no shortage of narratives right there, right now, about what's going on in the economy. A lot of them are not very positive. It seems like it's doom and gloom every headline we read right now, right? Whether it's tariffs, whether it's trade relationships internationally, whatever it might be, it feels like investors are scared. And this is truly a study in as much as finance and investing as it is in human nature right now. We like to have a consensus that makes us feel safe, like there's not a lion that's going to jump out and eat us. We want to go with the herd right now, and the herd is getting out of stocks. We're seeing funds flow out of equities into safer instruments. Now, of course, there is safety and stability in the herd, but it's also a great opportunity to find those babies that are being thrown out with the bathwater, to find those non-consensus ideas out there. This is one of the biggest things why I'm so excited to be chatting with James, to be chatting with Pieter, really smart investors that do their homework and the methodical research to find those insights, you know, those pins and needles in the haystack that is not being looked at by a lot of the narratives and a lot of consensus out there. That's what we go searching for as long-term investors. I'm really excited about it too.
Oh, absolutely. And it's really difficult to sometimes cut through that noise, isn't it? And to try to see the forest through the trees, so to speak, when it comes to what we're hearing out of here in DC, whether it's, you know, with regards to the tariff noise that we're hearing at the moment, you know, so how are we approaching the markets, guys? I mean, should we start to talk about some of your ideas and how you're looking at specific companies and names and stocks at the moment?
Yeah, sure. You want me to toss an idea out?
Yep.
Okay, so this, for those who don't know me, I ran for 10 years probably the largest dividend stock research service in the world, Motley Fool Income Investor. I am going to break that mold now and bring you something from China. For also about 10 years, I did cross-border business between the U.S. and China. And Sam, you and I have talked a lot about China. You're quite the China expert. I have qualms about investing in Chinese stocks. You're kind of partnering up with the Chinese government to a certain extent. You can't change that. One area, though, that I'm most partial to is Chinese medical, Chinese biotech, medical stuff. And I'm on the board of directors of the executive committee, I should say, of a Chinese U.S. Medical Research Association. So it's something I know very well. These people want to help the world. There's a ton more research coming out of China. If China is not your cup of tea, no problem. This is a risky stock. It actually mostly trades in Hong Kong and has an OTC listing in the U.S. Let me just give you some framing, though. The the XBI, the S&P 500 Biotech Index is down 12% year to date. The Hang Seng Biotech Index is up 35%. The reason is Chinese biotechs are making licensing deals left and right. This looks like an overnight success story. This has been 10 years in the making. There's a lot of these great analysts, great researchers. They call them haigui, sea turtles. They've returned to China from the US, returned from Europe, and they're bringing a ton of research. In fact, some of the big pharmas are starting to refer to China as the supermarket because there are so many great assets. In 2022, just 5% of licensing deals were from China. Now, according to, I have some notes here, it was Deal Forma. Now it's 42% this year. And the stock that I'm most excited about in this regard is called Akeso. They have a PD-1 inhibitor. This is an oncology drug. It competes with Keytruda, something that Jimmy Carter, former President Jimmy Carter of the US, used. It basically, without getting too much into the technology, your immune cells go and shake hands with all the cells in your body. And if the cell can't do a handshake, the immune cell knows that's a bad cell and it beats it up. The cancer cells are very smart. They can do the fake handshake. This drug blocks that fake handshake so the immune cells can know to destroy that cancer cell. And again, this is a $30 billion drug for Merck. This drug is in phase 3 trials now in China. It would still have to go to the US. They have a licensing deal with a company called Summit Therapeutics. They've got a few products on the market already, but the reason I'm bringing it up now is progression-free survival, which is a marker of how well a drug is working, is 11.14 months for this drug versus 5.8 months for the Merck drug. However, there is a little bit of a challenge. I'm looking for some data here. I'm not to see if I have my notes with like how high quality this safety data is. Okay, and people think no, they're holding them to too high of a standard. No, they're not. It's a weekend that we're recording this. The stock is going to trade down likely by the time people are watching this. So this could be a risky company that you could get on the cheap. Again, Akeso is the name, Akeso, highly risky just by nature. And it's possible, too, that Donald Trump says, you know what, I don't want U.S. companies doing these licensing deals with Chinese companies, and this company gets killed. But if not, this could be a real moonshot.
Well, they've already been doing that in recent years, and that has become a huge risk factor, particularly for this sector in China.
Yep.
But I see what you did there with it saying, not your cup of tea. Chinese love a cup of tea, but I'm glad that we're here to read the tea leaves with you, James, today. But talk to us, just quickly before we get to you, Peter, and also Simon, I just want to talk about how you can reassure investors out there right now about the risk factor with, looking at some of these Chinese companies. It's not just Donald Trump. I mean, you've got President Xi Jinping, who at any moment can pull the rug from under some of these sectors sometimes. I mean, like what we saw in technology over the course of 2021.
Sam, you talked about reassurance, and that's really the million-dollar question. Any investor thinking about China has to deal with that. Like, what's going to go on? There are so many moving parts. I think that's something that's priced into Chinese stocks mostly. And frankly, I think this Chinese biotech is inappropriate for like 98% of investors watching, pure and simple. Another one I like, another name is called Southern Company. SO is the ticker. And this is from my bread and butter dividend universe. It's a Southern U.S. utility company. In the U.S., the regulatory relationships between the utilities and the regulators really determine everything. And we say Southern has a lot of good old boy regulators. They're very friendly. They allow a lot of markup. And for a boring, stable company, it's going to grow its earnings 7 or 8% annually for the next couple of years. If this Chinese biotech was a highly thesis-dependent stock, Southern Company is what I'd call a no-thesis stock. Nothing special has to happen. No catalyst has to happen. There's no particular thing that has to happen for this company to do well. So that's something that's appropriate for a lot more investors.
Got it. And Peter, onto you. I mean, you tend to look at more sort of value and quality. And I think I read somewhere, what if Warren Buffett was Belgian? So give us a bit of an insight into that.
Yeah, sure. To give an idea, well, probably I would say probably more ideas than money right now, which is a great thing, right? But today in the US, a lot of uncertainty with the import tariffs. And I thought, well, as a non-US person, the not only non-US person here, might be interesting to give an European stock ID as a local. And that idea is Games Workshop. And I'm quite sure it's a company you've never heard about before, did you?
Only through you.
Yeah.
Through you. Yeah.
So basically, it's a very small company in a niche market. So they produce, well, miniatures for board games, which seems or sounds really odd, right? But one of the key things I learned from working in the industry, working in the asset management industry, managing a fund. So I live in Belgium, managed a fund there, and we did a fund of roughly 200 million in assets under management, which is peanuts in a Wall Street perspective, right? But even we could never invest in a company with a lower market cap. So the minimal threshold was 10 billion in market cap. And well, Warren Buffett, well, he said, go where competition is weak. So in other words, well, small caps, micro caps, that's where you can really make the difference as an investor. And why did in that case brought Games Workshop to you guys? Well, it's a small caps company. And not sure if you know it, James, the best performing company, US company, or the best performing US stock ever. Which one it is?
Was it Monster Beverage before?
It was Monster Beverage over the past 20 years. When you look at over the past century, past 100 years, I think it's Philip Morris.
Oh, yeah.
Yeah, so basically when you invested 10,000 in Philip Morris at the IPO, I think you would have more or less 4 billion today, which is amazing. And if you ask me, there are two main reasons for that. First one is they have a lot of pricing power. So year after year, they are increasing their prices, which is a great thing as an investor and a great thing as a business. And the second point you also have is, well, customers are very loyal. Well, Philip Morris, obviously, it's a cigarette company. And when someone starts smoking, they pick a certain brand, like Marlboro, for example, or Philip Morris, and they stay loyal towards that during their entire lifetime. And it's exactly the same for Games Workshop. So those two characteristics, pricing power and very loyal customers. And I can actually tell a very funny story about that. Well, when I was still with my former girlfriend, I was about to meet her family, and obviously you want to make a great impression. So I was a bit nervous, a bit stressed, and things started out well. I was getting along well with everyone. I'm having a lot of fun, and I felt welcomed to the family. So things were great. And obviously I'm very passionate about investing, very passionate about stocks. So I started to talk about investing with the uncle, and I brought up Games Workshop. And all of a sudden he started shouting at me, "Look, you are a horrible person. Do you know that? You shouldn't belong in this family." And it was a party of 25 people, and everyone was silent, and they started looking at me. And the silence for 10, 20 seconds, and it was one of the most awkward moments of my life. But then he started laughing and said to me, "Look, I'm a Games Workshop user, and apparently he stored over 100,000 USD worth of miniatures in his house of Games Workshop." So basically he said, well, Games Workshop is increasing its prices year after year. We absolutely hate it as a customer, but we want to keep playing. We are very loyal and we buy it no matter what. So also he had over 100,000 worth of Games Workshop miniatures at his house, and his friends had too. And I think that tells you a lot, and it's a very powerful. And when you, for example, then compare Philip Morris with Games Workshop, well, one of the key interesting things about Games Workshop is that it's still very small. So it has plenty of room for growth. And it has been a 100 bagger over the past 20 years. So it went up over 1,000% basically.
So he was an addict, and you were recommending his drug dealer basically, and he was mad at you for that, right?
Exactly.
That's the.
And basically, I made a small mistake. That's why I was resistant. So basically, it was up over 10,000%. I don't expect that trend to change anytime soon. So Games Workshop is an interesting one, if you ask me.
I hope that's not the reason that she's your former girlfriend.
One of the reasons.
No, but it's really interesting hearing your perspectives, certainly from, your Chinese sort of stock pick, but also with regards to your perspective from Europe, Pieter, because I remember looking at a chart at the end of February, and it was the rate of return on equities in dollar terms. And I was sort of comparing China and Europe to the S&P 500 and the Mag 7, and both were sort of outperforming. I mean, the difference a week can make in this sort of political climate is incredible, but I think it's just worth noting because, I remember one investor sort of saying to me, these are the two most hated markets at that time. And so, very interesting perspectives. Let's bring you in on that note then, Simon, shall we? Technology and growth, certainly coming from that angle. How are you looking at the markets right now?
Well, Sam, let's talk about something else that's equally hated out there, which is the T word, which is tariffs, right? It used to be taxes was the least favorite T word out there. Now it's actually tariffs. I feel like that's all that anybody really talks about anymore. But let's talk about like the second and the third degree of what tariffs are going to mean. Because right up front, the direct impact of a tariff might be something that's levied against a certain company, for something that's being traded in the United States from another country. There's also a second impact too, which is what is this going to impact, the consumer itself, the GDP, the consumer sentiment, the things like this. And some companies are not impacted so much by the direct financial impact of a tariff, but by the secondary impact of how is this going to impact sentiment. And the company that I'd like to bring to the table for this one is the Trade Desk. TTD is the ticker for this one. It's one of the largest digital advertising platforms out there. It's helping ad agencies find exactly the right website or podcast or connected TV streaming service to put the right ad in front of the right person for. And we've seen ad budgets in 2025, the forecast for them at least, coming down pretty significantly, right? There's a lot of people that are thinking consumers are going to, take a step back. We don't know what's going on out there. Of course, we hate uncertainty. Maybe budgets are going to go a little bit lower than we expected in 2025 for the advertisers, especially the brand advertisers that are going directly for consumers. And the Trade Desk, which is by far the innovator of this industry, one of the smartest people in the room at the helm with Jeff Green as its founder and CEO, and really one that just is consolidating power each and every single year. As you look at the ecosystem, it gets smaller because this is a tough industry to compete in, but the big keep getting bigger, and the Trade Desk is certainly one of them. In the climate that we're in right now, with a lot of short-term concerns about advertising and other things, we've seen ad budgets constrict. That has certainly impacted Trade Desk's top-line revenue, which is a function of those ad budgets themselves. But again, the stock now down 55% as of the last time I looked at it here in 2025 year to date. This is a company that's still growing even in a really, really tough time. Top line at 25%, converting more than 20% of the top line into free cash flow. And it's going to get even stronger against its competitors as they get flushed out in the short-term concerns that they're facing right now. I really like the Trade Desk right now. I think it's at least 33% undervalued as it's trading today.
Yeah, that's really interesting because obviously every investor right now is sort of scrambling to try to find these pockets of the market that is arguably sort of insulated from that word tariffs, right? And so that's a really interesting pick there. Have you got any other sort of areas that you're looking at that you can sort of highlight to us that might also be sort of insulated from a lot of the sort of headline noise that we're hearing about at the moment?
I sure do, Sam. In fact, James introduced me earlier as the growth style investor. I've got the wave of the future for you. Are you ready? We're ready. It's plastic shoes. I'm going to go with Crocs, CROX. This is amazing, right? The wave of the future. You can keep your kids' shoes on, jump in a swimming pool, doesn't matter. I'm, of course, kidding. It's not the wave of the future. This is a very value-focused company, only growing at 3 to 5% per year. But everyone's concerned about because they do some of their manufacturing of their products, of their shoes that they're selling in China. In fact, it's only about 25% of manufacturing comes from China, 50% is coming from Vietnam, and the other 25% is coming from North America. But there's really been a lot of focus on, hey, is tariffs going to increase the costs of shipping these into the North American market or elsewhere? And then what's that going to do to Crocs' margins? The reason why this is so interesting, Sam, is first of all, this company is already capturing a 24% cash flow margin, much, much higher than a lot of its competitors. So even if it wanted to stay at the same price point, it can accept a little bit of a lower margin where its lower competitors, which are at about 7-8% margin, simply cannot. And secondly, this is such a beautiful value stock here because in addition to getting a 24% cash flow margin, a 30% return on invested capital, it's selling at 6 times free cash flow. It is one of the cheapest stocks out there right now. And so what is management doing? They're saying, you know what? If you guys are going to give us our own stock, we're just going to buy it back as much as we possibly can. $1.3 billion share repurchase authorization could buy back about a fifth of the outstanding share count. That's exactly the recipe for success that Crocs has followed for the past decade, and they're getting an even better deal on their shares right now.
Interesting. I mean, absolutely, it's great to find those little pockets and, as you say, the recipe for success. And if it's working for you as well, I mean, I'm a little bit, I'm fascinated by these Croc charms that you can put on. I bought my 1.5-year-old a pair of Crocs, so this is a whole new world for me. But so let's get back to you, Pieter. And as James and Simon had been sort of discussing, stocks with the sort of greater, broader appeal, you obviously spoke about something a little bit smaller in that shopping list. I just want to know what you're adding to your cart in the US here.
Sure. So also the majority of my investments are in the US. So I'm happy that you ask. And one company that I definitely also like is Kingsell Capital. And Kingsell Capital is an insurance company. And to be more specific, well, it's an insurance company active in E&S, meaning excess and surplus lines, which might seem complicated, but it basically means that they are insuring very specific high risks. And to an investor, that might sound risky, but basically one of the key advantages that Kingsell has is they have way better data and way more data than their main competitors. And as a result, they are way better in analyzing the risks and asking the right premium to clients for them. And that's very interesting. And another fact you have there as well, you have the CEO and founder as well, Mikey, who is running everything in an excellent way. And last time I met with him, well, I asked him a question. Basically, insurance companies, they receive premiums and then they invest them. And right now they are outsourcing all their equity investments to BlackRock. And I asked him, well, when are you going to do everything in-house? And he said, well, when our assets would triple, we would do that. And we will have that rather sooner than later. And when he said that, he was a bit surprised about himself. Look, I didn't need to have to say that. And it's a bold statement to make, but last year I read everything Warren Buffett has ever said and written, 5,000 pages. And when I first found out about Kingsell, it reminded me a lot about what Buffett said about Geico 40 years ago. But obviously, Geico has been tremendously successful. So if Kingsell can do the same, well, I would be very happy.
So if you're a CEO, be careful because Pieter's going to come and charm some proprietary information out of you, like it or not.
So we've heard some really interesting perspectives and ideas coming from all three of you. And so I really appreciate you sharing some of your thoughts with us today. As we talk about breadth in the market and diversification, how should we be approaching that with all these kind of different perspectives and ideas in mind?
I'll give a technical answer. I think the S&P 500 equal weight is a much better bet than the regular S&P 500 via an index fund, which is capitalization weighted. It's getting better, but the Mag 7 have been dominating stocks for a long time, and now they're not anymore. And it might be the resurgence of the little guys, in which case you're going to want an equal weight. There's one, RSP is the ticker equal weight S&P fund, but that's more of a technical thing. I think the main thing is if you're not sure what to do in this market, don't do anything. There is nothing wrong with sitting on your hands. That's what you should be doing most of the time as an investor. Don't try to chase policy. Don't try to guess. When you see something show up that's really, really cheap for some catalyst, great, pounce, and you should pounce. But aside from that, no plan is okay. You don't need an aggressive plan right now.
And what about your thoughts, Pieter?
I'm very happy that I found a friend who agrees with me that you should buy the equal weighted S&P because it's a very unpopular opinion, but I've been saying that for 3 years right now. And almost a lot of people disagree, but with the outperformance of big tech, well, I think it's very smart to do something like that. And I also think a very important point to make is in Europe or in Belgium, we say, well, there are multiple roads that lead to heaven. Maybe, or multiple roads that lead to Rome. Maybe you say multiple roads that lead to heaven.
We say Rome.
Rome, okay.
Belgians equate heaven and Rome.
Yeah, exactly. So learn something new. But basically, obviously, you have your investment strategy. Simon has his investment strategy. I have mine. It's just very important that you pick a strategy and pick stocks that you feel comfortable with. Because there is a saying, well, you can borrow someone's stock ID, but you can never borrow their conviction, and that's so important. So obviously we are giving IDs right now, but only invest in them if they make sense to you, and if hopefully you like mine ID, but if you think James' ID is better, well, please invest in his ID. That's what my message would be.
Simon, let's bring you back in. What are your thoughts about this? What are you thinking?
Sam, I will be the third to agree with both James and Pieter that the S&P 500 as a whole was just getting too pricey, right? The Mag 7 in this market cap weighted index was now a third of the S&P 500. And in terms of the cyclically adjusted PE ratio, which is kind of a nominal way to look at how expensive stocks are, right before this recent downturn, it was the third highest point it's been in the last 30 years. The only two times that it was higher was in 2022 and then in the year 2000. So thank goodness we're looking at some of the mid caps and the small caps and the value cap companies again. I will just add to the points as well that I think that the knee-jerk reaction from the market from this was basically to get out, right? There was fear and there were margin calls and there were people pulling money out of equities. That was kind of the first phase. I think we're now progressing to the second phase where it's going to go through the legal system, both to contest tariffs on a specific company level, and then also I think there's going to be kind of the negotiation on the country level. People getting on the phones together, talking with the Trump administration, figure out what this is going to mean for countries specifically for the reciprocal tariffs. And then I think that the light at the end of this tunnel that we're going through right now is going to be the longer term. This is going to be more of the opportunity for the long term investors. If we've already gone out there, we've kind of seen the panic and the fear and the initial reactions. I think that there's actually going to be a more optimistic tone as we realize this might not be as bad as we thought. The discounted cash flow models that just said, okay, 10% blanket tariff across everything on this company's product lines for the next 10 years, maybe it's not going to be that dramatic as it's seeming in a lot of the narratives here recently. I think that's very positive for stocks and really good for stock pickers like us.
So guys, we've had some wonderful conversations and you've obviously shared some really valuable insights today. And I think that very much speaks to how we sort of need to diversify the way that we approach the markets, beyond just balance sheets and what we hear on the news and reading the headlines. And so I'm just wondering, how you're thinking about, alternative inputs as far as what people are saying about the markets and, how we should be perhaps approaching things from a more holistic picture.
Great question, Sam. I've been in finance for almost 30 years now, and I know for a fact in these rocky times, people watch the news more, people read about finance more, and that's all fine and dandy. People are nervous, but I'm actually turning more to alternative sources like the stock I mentioned at the beginning, the Chinese biotech. Akeso, that the CEO of that group is actually in a Chinese WeChat group that I'm in. And so I know some of these people personally. Like I'm learning about these things through my own networks, digging up these alternative ways. I almost use the crowd as an inverse barometer. Like the more irrational the crowd wants to get, the more rational I want to get. And that sounds easy, but it's super hard to implement. But if you can do it, and I'm trying to do it, I'm not saying I've mastered doing it, but if you can do it at a time like this, this is when fortunes are made.
Yeah, my conclusion would be if you look at the Dow Jones, for example, at the start of the 20th century, we had a Spanish flu pandemic, we had COVID, we had World War I, World War II, we had the financial crisis, the dot-com crisis, and so on. So a lot of uncertainty, a lot of bad things going on. Maybe that's a bit similar to the uncertainty with import tariffs right now. And yet the Dow Jones, it rose from 26 points to over 40,000 points today. So, Warren Buffett said, the only person or the only thing that can happen that you aren't making money in the stock market is yourself. So as long as you are using a long-term mindset and focus on buying wonderful companies at a fair price, you will be fine.
And I'll add just consumer sentiment too. We're kind of wired left brain and right brain, right? The technical side of it versus the emotional side of it. And the emotional side of it is definitely kicking in recently. There's a lot of fear, a lot of anxiety. Consumer sentiment is very low right now, but I think that's a great time to, they say it, think fast to think slow. Look at more of that left side of the brain of saying, our stock's going on sale. Is this the great opportunity to do things? That's what I really like to look at is, the investors that are saying, hey, it's the time to buy. When everyone else is selling, those tend to work out to be pretty good if you bite the right companies and hold on to them for 3, 5, or 10 years or even longer.
So we've shared some really interesting insights into what to do in this environment and sort of the approach you guys are taking to the market. And we want more. So let's do it again. But in the meantime, Pieter, start with you. How can we hear about what you're thinking right now at the moment?
First of all, I would definitely say, it was definitely worth it to fly from Brussels to Washington, D.C. to have this conversation. And obviously, I'm writing under compounding quality, so people can read everything there. I think it sums it up quite well, compounding, the magic of compound interest, and then quality by trying to buy and invest in wonderful companies.
Yeah, and Simon, where can we pick your brains until the next time we do this?
Oh, Sam, I love this. Have me back anytime. I love talking with Pieter. I love talking with James. These are smart investors. If you want to see our actual stock picks at 7 Investing, that's 7investing.com, or I'm at 7Innovator on Twitter X out there.
So, Sam, if people want to hear more from me, if they go to CuriaFinancial.com, that's spelled CURIA Financial.com, you can get what I put out weekly at this point, and anything else that we do collaboratively will also be at CuriaFinancial.com.
But wait, there's more, because if we haven't crammed enough in already today in this wonderful conversation, because time is of the essence in TV land, as we know, you can actually get a report on more of what we've discussed, a little bit more meat on the bones.
That's right, Sam. We talked about actually 7 stocks today. We talked about in total. And if you forgot any of those or want more information, especially about some of the ones we didn't cover as deeply, go to that same website, curiafinancial.com. If you do that right now and give your email address, you'll get that report.
See you again next time. Thank you so much.